Behind the oak-panelled walls of Westminster, where every word is weighed and every pause is deliberate, a quiet claim has begun to echo through the corridors of power.
That does mean
interest rates are falling. Borrowing is getting cheaper. And Rachel Reeves wants the country to believe one thing above all else: this is her doing. But as the headline celebrates stability, a darker, more uncomfortable story is unfolding beneath the surface, one driven not by confidence, but by fear. Before we unravel what is really happening inside Britain's economy, make sure you hit the like button, subscribe to the channel, and leave a comment below. Your engagement helps this video reach more people, and the more voices involved in this discussion, the harder it becomes for the truth to be ignored. This week in Parliament, the Chancellor stood confidently at the dispatch box. She reminded MPs that the previous government had driven taxes to record highs and sent interest rates through the roof. Labour, she said, had done the opposite. Labour had restored stability, and because of that stability, the Bank of England had cut interest rates 5 times. Lower borrowing costs, Reeves declared, was the most pro-growth measure of all. On the surface, the claim sounds convincing. Since Labour entered office, borrowing costs have fallen sharply. Markets are now expecting a 6th cut, potentially bringing the base rate down from 4% to 3.75%. But here is the uncomfortable truth. The Bank of England is not cutting rates because it believes the economy is thriving. It is cutting because the jobs market is breaking. Unemployment has climbed to levels not seen since the pandemic. Payrolled employment has fallen by nearly 180,000 since last October. Vacancies have collapsed to below 725,000, the lowest level in over a decade, excluding COVID. These are not the hallmarks of confidence. They are warning signs. And they matter deeply to the Bank of England's Monetary Policy Committee, which meets again on Thursday. Financial markets are already braced for another cut. But the Chancellor, sensing the moment, has moved early to claim the credit. We wanted to reduce inflation, Reeves said. And that is exactly what we did. She pointed to comments by the bank's Deputy Governor, Clare Lombardelli, who acknowledged that the budget could knock between 0.4 and 0.5 percentage points off inflation next year. Policies such as freezing regulated rail fares, holding down prescription charges, and scrapping certain green levies on energy bills are all expected to dampen headline inflation. But here is what Reeves did not say. Lombardelli also warned she was more concerned about upside risks to inflation. And crucially, she did not suggest that lower inflation automatically means more rate cuts. In fact, economic theory tells the bank to look past these short-term, one-off measures altogether. Interest rate decisions operate on a 2-year horizon. What matters is not whether prices are nudged lower in 2026, but whether the underlying economy is heading towards sustained stability or renewed inflation. On that front, many economists are uneasy. Robert Wood of Pantheon Macroeconomics believes Labour's decision to ramp up public spending could actually push inflation higher in the medium term, making further rate cuts harder to justify. Others on the MPC take an even more cautious view. Households, scarred by the cost of living crisis, have not forgotten what high inflation feels like. They see it every week at the supermarket checkout. And instead of tightening their belts, many are demanding higher wages to keep up. If employers give in, business costs rise. Those costs are passed on to consumers. And the vicious cycle begins again. Catherine Mann, one of the bank's more hawkish policymakers, sees this as the real danger. We have household and business expectations rising, she warned, even as inflation itself falls. In other words, the psychology of inflation may prove stronger than any single budget decision. Even if the Chancellor succeeds in lowering inflation next year, the deeper forces remain largely untouched. Wages, employment costs, global commodity prices, taxes like the plastic packaging levy. And looming over it all is Reeves's own record. Last year, she launched a £25 billion increase in national insurance contributions paid by employers, a move widely blamed for accelerating job losses. More pressure is coming. A rise in the minimum wage. A sweeping employment rights bill. And from next September, an increase in fuel duty, one of the most visible and politically sensitive costs of all. Markets have noticed. Despite confidence about an imminent rate cut, traders are now pricing in fewer cuts over the next year than they were before the budget. If Reeves deserves any credit, it may not be the kind she wants. At the centre of this moment stands one man, Andrew Bailey, Governor of the Bank of England. Widely seen as the swing voter on the MPC, his decision to hold rates last month tipped the balance. Since then, the data has shifted. Unemployment is higher. Pay growth is slowing faster than expected. Inflation came in weaker than forecast in September and met expectations in October. For some economists, that is enough. Robert Wood believes the deterioration in the jobs market should be sufficient to push Bailey towards backing a cut. The hard data, he says, have been weaker than expected across the board. Add to that what he calls budget chaos hitting sentiment, and the case for easing grows stronger. But this brings us to the final, unsettling question. Are interest rates falling because inflation is finally under control? Or because Britain's labour market is weakening so fast that the bank has no choice but to act? If it is the latter, then lower borrowing costs are not a victory, they are a warning. And if that is true, the applause Rachel Reeves hopes for may never come. Because when workers look back on this moment, they may not remember cheaper mortgages. They may remember lost jobs, rising uncertainty, and a stability that never quite arrived. So what do you think? Is this economic progress, or a calm before something far more dangerous? Leave your thoughts in the comments below, and don't forget to like the video and subscribe to the channel for more deep analysis of the stories shaping Britain's future.